So we have almost. Anybody else know has a Bloomberg account?
Yeah.
They're going to try. It's not picking my account, so I don't know.
Your account is coming from this country or from your native country?
No, it's here. You know, during the Bloomberg certification.
I see.
Yeah, so open an
There's a
account.
difference. There's a
They
difference.
time out though. You got to log in every so often.
Okay. Yes, I know.
So I had to make a new one this year after having done the course last year.
Yeah, exactly. It was last year.
Okay.
But I normally log in.
All right. So what we want to do today is because somebody complained to me, and you know who complained, that the course is not intuitive enough, right? So because we're not going to mess up with this complainer, we're now going to do it. We're now going to introduce some practical flavor
Let me know the complainer. They can wear
to
cement
the course
sneakers.
that I did, and it's using for the 50s. Okay, so when I actually log in into Bloomberg, okay, what I want to show first of all the major screens that you can actually look on the market, and then we're going to jump a little bit more into fixed income. Okay. So the first thing is that when I'm going to Bloomberg, I'm doing USSW. Okay. This is basically what they call the swap markets, but it gives you like a holistic overview of the US market. So when you click on that, okay, you basically have this part is fixed income, this part is equities. Okay, so we see here, for example, that the Nasdaq dropped today by 114 points. You know, the Dow Jones shed 469 points. The Nasdaq actually shed 521, and the Bloomberg European Index shed 17 points. Okay. These guys here are the rates of the government bonds. So this is a 2-year government bond. Today 386, and you can see that it dropped by tenths of a basis point, right? The units here are percentages. These are the 3-year government bonds, 390.87. It went up a little bit. 4-year, the benchmark usually is a 10-year. You see that the 10-year did not move. It is still the 4412. Okay? The SOFR is basically the Federal Reserve benchmark. And we're going to discuss swaps today, so you will see exactly where this is coming from. This SOFR is different from the government bond. So if the government bond is 3,786, the SOFR spread is 19 basis points. So these are basis points, okay? And 396 minus 19 is going to give you the 37966. This is basically the SOFR here, right? So the SOFR is basically the swaps that are actually being traded between banks. That's why it is different from the rate that you see here for the government bonds. Okay? And then you have the federal funds. The federal funds are actually the short-term, you know, the short-term rates that you can actually borrow or lend between banks. Okay? So this was used to be LIBOR. Now, since I think 2023 or 2022, it is the SOFR. This basically the Fed took over because there were a couple of scandals with the bank. Now, if you want to look for economic releases, right, you type ECHO, like this. And you can see, for example, so this is a weekly, this is initial jobless claims. Okay, you can see that this is going to be the jobless claims that were, you know, for the last week. Okay, this is seasonally adjusted. So So basically, the Bureau of Labor Statistics and the Department of Labor, who is responsible for this number, they do some massaging of the data to actually adjust it to the season, because job numbers are seasonal, right? So for example, during holidays, okay, we have a lot of jump in jobs because people want to buy, right? So the people, the shops hiring a lot of temporary workers, so they go out of the unemployment rankings. So also the initial jobless claims it's adjustable. Now, if you want to dive a little bit more into this economic data, right, you click on description here. And if you click on description, it will give you exactly, right, what does this benchmark does. Now, if you go back to USSW, so let's go back to USSW. Okay, so now, so this was, okay, so now what we want to do, we want to dive a little bit more, right, into each of these markets. And unfortunately, I will not be able to cover everything. I will be able to cover as much as possible. Okay, so let's first look on the equities. So the equities, right, is SPX index. Is basically going to be the benchmark for all the equities, and we did it in the first, part of the course in the first semester, where we discussed equities, we discussed risk management, and we also discussed this time, right, when we take about volatility decomposition. Okay, so now if you want to see the graph of how this SPX looks like, you do GP like this.
So we need to remember all of that function.
No, you don't. I mean, this is just for you, because people explain to me that I'm not intuitive enough, so they want more storytelling. That's why I'm doing this, right? So you don't need to remember this function, but what you want to remember SPX. Yeah, and if you want to actually do help, you can do help here, and then you will have all kinds of Bloomberg, so you can actually, for example, connect to a help desk, right? And then you have a chat. Now, from my experience, I didn't find it too promising, this, right? So when I was doing this stuff, I was figuring out by myself. You see, so here, for example, you can actually see here the GP, which is basically the graph price, which gives you the ends, right? The GIP, the intraday price, how the market moved during the day, okay, and the SPX index, which gives you the by how much it dropped. So it dropped by 114 points, which is kind of little brutal, I would say, but okay, it is what it is. Okay, so you do graph price. Okay, you can see here those, how the S&P is moving, right? From, let's say, from April last year until now. So it was on a very nice trajectory of going up, and now it starts to go down, and we know why. Okay. So now, if I want to go to the Nasdaq, right? I do Nasdaq here. And it will give me the Nasdaq, the Nasdaq index, right? So you see that it's NDX. So if we do NDX index, it will give you the Nasdaq 100, the heaviest Nasdaq stocks. Okay, and once again, right? Oops, NDX GP. Okay, so this is how the Nasdaq behave during the less whatever. Okay, and you can actually also do SPX returns. I think you can do something like that. And this is SPX return index, right? So when you do GP, it will give you the total returns, right? So this is a total return. Okay, so these are the returns, but you are kind of, it's common, it's cumulative returns. Okay, so so whenever it started, now it's 1444. So it starts with $100 whenever it started, okay, and now it dropped to 1444. The high was on the 27th of January 26. We can see it here. Low was on the 8th of April 25, and this is because it's coming in the last year. Okay, so stocks are not doing anything in the last year. Now, if we look on something that everybody are interested in, right? Oil. Oil is traded through futures. I don't know. Have you covered futures in other courses?
Yeah.
Yeah. Okay, so oil, right? And this guy can actually, he's an expert on this, not me, right? Oil is traded on futures. Okay. The most traded contract. So you have two contracts, which are actually leading contracts in the U.S. for oil. The first one is CO1 commodity. This is a crude oil, which is Brent, right? And the CL1 commodity, which is WTI. So it depends on how you say the density, David. It's the density, right?
Yes, that is it. Yes.
It's a density of oil,
yes,
right?
Yes.
Yeah. So for example, in the US, the oil is horrible. In the Gulf, the oil is very liquid, and that's why everybody's kissing their asses, because the oil is easy to refine. In the US, oil is not easy to refine. I don't know about Venezuela.
Which is the problem in Venezuela?
It's also
Yeah, it's
like
very,
in the US.
very hard.
Yeah. So let me just show you. I think I can actually do this picture. I saw it somewhere. Fox. No, not Fox. Firefox. And this is not part of the test. I'm not going to ask you about oils, in the test. It's not my job. Somebody else should teach you this, not me. Okay, so Brent versus WTI. Visual.
Lights versus the heavy.
Yeah, this is, I want visual comparison. Let's see if this is going to. Oh, here. You see? That's the light sweet, and this is sick bag. This is United States, this is the Gulf.
Oh.
Right? So the Gulf is much more much easier to refine, right? Compared to this United States. Otherwise, nobody would actually piss over, into this area, because it's crazy area. Okay, so hopefully I didn't hurt anybody.
No.
There is a problem when the Venezuela thing, when Trump was approaching the major oil companies, they are finding it very difficult to go in.
I know.
It's because
I know.
of the.
I know,
the
but it's also
density is
because of the governments there.
Yeah, and the cost of processing it is very heavy as compared to the one
I
in the
know,
Middle East.
I know, but maybe we won't have a choice, would we? There were no refineries in the US built for the last 50 years, right?
Exactly.
So, but now they're starting to build it again.
Well, that's
Hallelujah.
fine.
Okay, so now going back to Bloomberg, so this was, this is for you, lady boss, that you will not tell me that I'm not intuitive enough, right? So, how oil is traded? Oil is not traded physical. This is not gold, right? Oil is not traded physical. Oil is traded based on futures. So if you go now to CO1, I think it's April, right? CLH, CL1 commodity. Okay, let's try this. Okay, So if we go to CL1 commodity, we go to security description, okay, and we will see exactly, right, what is the underlying security. So this is going to be, right, this is going to be the contract on the run. You can see that it's 1,000 barrels of oil. So all these contracts, right, the minimal size of a contract on an oil, okay, is going to be 1,000 barrels, okay. The price now is 93.14, right? So it dropped. I think it dropped a little bit. Now if you want to see, now this is a generic contract, so it's not a real contract. It's kind of the most traded contract, okay. Now if I want to see the actual contract, right, I need to go to one of those guys, let's say CLH26. So this already was traded, you see. This is the 21st of January till 20th of February. We are now going to be not in CLK. Where's the April one? Okay, so if I go to CLY, let's say, CLJ 20, yeah, CLJ6 commodity, exactly. So this is a contract, right, which is being actually traded. This is a contract which is being actually traded. When I look on security description, you can see exactly, right, how it is going to look like. So you can see that you have how long you have to deliver this oil, right? So this is a one month contract. So when you actually hear about the oil price, right, this is what you're looking for. You're looking for a 1 month futures contract on either crude or Brent, right? On one of those guys. Okay? This is going to be a crude future, so it's probably this one. This is a United States one.
Sorry, where do you see it's a 1 month?
What do you mean where? I read.
Okay,
Right? If you go to, okay, you see the last delivery,
Yes.
right? So first delivery
Oh, I
is
see.
on the 1st of April,
Yeah.
last delivery on the 3rd of April,
I see.
right? So you have 1 month to deliver this oil.
Yep.
If somebody wants physical, right? Why 1 month? Because the oil, you cannot raise the oil, you cannot take 1,000 barrels, right? And put them here to store them, right? You can't them, right? So you have to store,
Yeah.
okay? So that's why, so storage, delivery, okay, everything together. It takes at least, they give you at least of a month to do it, okay? Now, if you go to the other one, so this is the crude, this is this one, right? If you go to the light sweet, if you go to the Brent, I think the price is higher, right?
Yes.
Why is it? Yes,
And-
lady boss.
An individual, we can't trade this one, right?
You can't trade it because do you have money to buy 1,000 barrels of oil, lady boss? If you have money to buy 1,000 barrels of oil, you wouldn't listen to me.
No.
And then
No,
also the
point
storage,
is that
the issue
the
of the storage.
physical, the storage.
The physical, yeah, but people trade physical, right?
Oh.
Refineries. Well, how do you think you get gas, right? So refineries trade physical. Refineries, when they are actually entering into this contract, right? They insist on deliver physical. Okay. Now this is the forward looking. Okay. It reacts. It's basically it reacts to the but this is what is traded on the market. So by the time the oil is delivered, right? You're not trading the physical. You're trading this. Okay. Now.
Actually, I have a question. So since like oil is like a future, so when we talk about like compare between gold and like oil, which is the future, like are we comparing the gold future to oil future or?
Well,
just
that's a
the
great
actual-
question. That's a great question, right? What you want to do, you want to compare 1 month gold futures to 1 month to one month oil future, right?
Okay.
However, the gold future, the 1 month gold future is practically indistinguishable from the gold price, from the physical gold price. Okay, so it's kind of it's kind of a wash. So they compare the prices. But you're right. You want to compare this to 1 month to 1 month,
Okay.
right? I mean, most of the commodities that are not being traded on physical. For example, food, right? Is agriculture commodities also like that. It is not being traded on physical. Okay, you always buy and sell futures. Okay, so and you can see that oil is being traded on a monthly basis, because here you have the CLJ, right? It's the April. Now if I go to May, it's going to be CLK 6 crude oil, right? And now, well, it's now drops because people probably assume that, so it's a 2 months contract, and it drops because people assume that, you know, by May, this thing will actually stabilize. I'm not sure about that, but you know, this is just my opinion. Maybe I'm not right. We'll see. Okay. Now the other one is going to be CO, I think. Yeah. So we want this, lady boss, right? You see the CO1 commodity. You see that it's actually higher. It's 108.
Yeah.
Why is the difference?
No.
Because this is coming from the Middle East, right? Can you deliver now anything from the Middle East? Probably if you pay $2 million to the mullahs, to the Iranians, right?
Yeah.
So you probably can deliver this, right? That's why it's actually 15 years higher, $15 higher, because you know you have the yield, right? The extra premiums that you need to pay to deliver this. Okay. So if you go to, I think it's COK 6, this is the contract itself, and COJ it was, I think, COJ 6, right? This is the ones that actually expires in April, so it's not even being traded. COK, let's say COK 6, probably it's not traded because you can't deliver. That's why it can't be traded, right? Yeah.
Insurance costs have increased tremendously.
Oh yeah, baby, I know. Right. So we have a security description here, and you can actually read everything about this that you never, right? So current pipeline export, blah 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 blah. So he is basically explaining to you, right, what is the physical that they actually trade on. This is like quality brand supplied, blah. You know, for me it's not. You know, for me it's basically like to you, because I'm not a commodity trader, but if I were a commodity trader, I would actually understand what's going on here, right? So this is a contract for this, and you can see that the contract is actually traded only for May. It is not being traded for April, because for April probably, you know, people cannot deliver this. So that's why they suspended it, yes.
So this is not a physical delivery, it's suspended because there is no such a thing you explained before.
No, this thing for the May contract, not for April, right? So you can see the contracts here, right? January, so COF, so let's say COF 7, right? Is going to be a crude oil in January 27. You see how it works? And you can see that it's 83, so people actually seeing that by January it's going to go to normal, right? So you can see here you have the F, the G, the H. So COH is going to be March, right? COK is going to be May. COM is going to be June. Okay?
Yep.
That's how it works. Okay, lady boss. Now if you want to see, right, the price of oil, the price of the contract, you can actually go to CL1. Let's say you go to CL1 commodities, this is a crude, right? This is this. And you can look on GP or on graph price, and it will give you the, you know, it will give you the graph price of oil. You see? So this is basically a rolling 1 month contract, right? So if you are in December, you are going to look on a contract that expires in January. And if you're in January, you are going to look on the contract which expires in February, etc., etc., etc. Okay? So you can see here, right, that you had a spike. So it was around what, 62, and it had a spike to almost 100, right?
Yes.
So it's what, 60% 2/3. 4/6, yeah. It's 2/3. It's like 66% spike from when the war started. And I think it was 20th of February, 28th of February when the war started. It started to go a little bit higher then, right? And then it spiked to this amount, $200. And they think what, 200 if they start bombing?
Yeah, exactly. 200, that was the speculated price it will go.
Yeah, but they didn't. It go only 200.
Yeah.
But maybe it's just, the start, so we'll see. So if you go now, right, so what you want to do, you want to compare it with the gas prices. So let's say you want to see gas prices. How gas prices are fixed, right? It's coming from here. GL
So
code.
it was a weekend. It was on Saturday they launched the attack.
Yeah, I know. Aren't they smart? But they I think they did the attack on Saturday because they wanted to get all these guys.
Exactly.
Yeah.
So it increased before because there was a speculation probably the war will start.
No, there was a negotiation, right?
Okay.
But nobody actually suspected that they will.
Okay, but there was a little bit of increase.
Yes,
before.
there was an
Yes.
increase, but it's not.
Okay.
We don't think that it was actually connected to this.
Okay. Or someone traded from the government.
Maybe. Well, maybe. Yeah. We'll see.
It happened 2 days ago.
Yeah. One of it.
Okay, so let's go back. Let's go back to the curve, right? So what we want to do now, we want to look on actual government bonds, how government bonds are traded, right? So you go to TY. Let's see, no Treasury. The government, right? Okay, so this is going to be, right? This is like the Gaza. This is basically the treasury, right? The treasury, the actual bonds which are being traded. Okay, so if you look, for example, here, you click on that. Okay, so how do you identify those bonds? You identify them using this identifier, which is called the QSIP. Okay. Every QSIP, every debt, every bond that is issued by the United States government or is issued by anybody, right, in the United States or anywhere in the world will acquire this number, which is going to be called QSIP, okay? And this is the entire debt of the United States government. Now, for example, you can see here that it's not 38 trillion, okay? So this is one of the, once again, fake news media, right? That they say that it's what, 38 or 40 trillion, right? A lot of this is actually sitting on the Federal Reserve balance sheet. So it's basically the left hand, right, moves the money to the right hand, and the right hand will move the money to the left hand, right? So the public debt outstanding, those are the public debt outstanding, I'm not sure. But I don't think it's 38 trillion, it's much less. Because if you are in the Fed, right, with a click of a button, you can just cancel the entire debt. Okay? So now, if you want to look on how the actual mechanics of how it is being traded, right? So you go to security description, okay? And for security description, this is your bond information, okay? So this bond was issued on the 17th of February 2026, right? Until when? When is the maturity date? 15th of February 2036. So it's a 10-year bond. This is like the newest bond that probably was issued by the government, right? The 10-year is our benchmark. We measure everything. All fixed income securities are basically measured directly or indirectly versus the 10 years. The 10 year is a benchmark. When you look on the rate, right? You look on the rate of the 10 year. Okay? Now, the bond, right, is paying what? The coupon is 4.4125. How many times the coupon is paid? Anybody can tell me. How many times the coupon is paid? If you look on this, can you tell me how many times?
SA something. but
What is
this
SA? Semi-annual, right?
Ah,
Coupon
semi-annual.
frequency semi-annual, lady boss. And if it was QA, it would be what, Lady Boss?
Quarterly.
Quarterly. Very good, Lady Boss, right? So this is going to be, right, the actual mechanics of how this bond is traded. The coupon is 4125, right, on a principal, or whatever the principal is. It was there. I don't recall the principal now, right? So you take the principal, you multiply by 4.125, you divide by 2, and that's how you are going to actually, that's how it is going to actually being traded. You see the QCP is here, right? This is basically the identifiers of the bond. So you have the ID number, you have the QCP, the ISIN, and then CIDO. So and Fiji is a Bloomberg one, right? So those are basically the security identifiers. Okay, what is the duration? Anybody can tell me where the duration is here? It's a risk factor, right? Risk factor is your duration. We will talk about risk and Bloomberg in a moment, right? So risk factor is your duration. So the duration of this bond, right, is 7833, AA 784, give or take. Okay, now how those bonds are being traded. You can see here that you have a yield, right? And you can see a price. So they're basically being traded on a yield. So when two traders, right, want to trade this bond, they call each other and they agree on a yield, on the discount yield by which this bond is going to be traded. And then once they have the yield, how do they determine the price, I wonder? How they determine the price? Once they have the yield, they claim that they can determine the price. And you know how to determine the price, you just forgot.
It's discounted.
Exactly. How I call it? The magic formula.
Yeah.
Right? Right, exactly. So from this, you go to this, right? Because of the magic formula. Now this 21 plus is crazy Bloomberg crap. I can't recall what it is. Okay? So the amount outstanding this is the principal, right? So it's 92,910 millions. So I think it's around what, 92 billion or something? Almost $93 billion, right? That was issued on the 17th of February to fund the operations of the US government. Okay? Questions? Now, exchanges, right, is where this bond is being traded. Right? So you see that this bond is being traded mostly in Germany, in Europe. So probably some sort of a shell company for China or Vietnam, or some European investors, some European central banks, right, are actually buying this bond, are actually buying it. Because if they will not, if United States will not have enough people to buy those crazy bonds, United States will be in a deep, deep doo-doo. Yeah. Okay.
So who is requesting to be traded on those exchanges? US or those
US doesn't ask anything.
Okay.
US, everybody licking the shoes of the US.
Okay,
Yeah.
so those countries
Yeah.
asking to be
Yeah,
to
those
be
are
able
not,
to trade
this
on
is
them.
Germany,
Yeah.
yes, this is Germany.
Own Germany.
Right, it's just Germany here, right? Because with all the pitfalls, the United States debt is the most stable debt in the world, right? Compared to Europe, for example, right, which is an individual, right? Yeah. So, for example, the immigration situation in Europe is much worse than in the US, because Europe is not. America is an immigration country, right? Europe is not. They are pathologically xenophobic and racist.
So it means that if I live in that city and I have money, I can buy this bond.
Well, if you are actually living in this city, right, and
Yeah.
you're working for an insurance company, right,
Yeah.
you can actually buy this bond.
No.
This is not retail investor, Lady Boss. These are all bankers, investment bankers. These are not retail investors. Okay, if you want to buy retail investors, you're not doing it through this. I'll show you exactly how you do it. You do it through Treasury bond. Treasury is a Treasury direct account, not like this. Okay, because this is basically buying on scale. They can buy, hundreds of millions of dollars of these bonds, maybe even billions.
Yeah.
Okay, retail investors cannot do that. Okay. Now, if you do YAS, it will give you, right, the yield of the bond, and then all kinds of spreads here. Okay? So this spread, for example, right, is going to be the spread to a zero coupon bond. So this yield, okay, is a coupon paying bond, but you have a zero coupon bond, right? And a zero coupon bond which matures in 10 years will not have this yield. It will have this yield plus 47 basis points. So that's why you have what they call it, this spread. And those kind of spreads as well, I'm not sure what they are, you know, so you will have to forgive me because I never, you know, I mean, I didn't trade that much those bonds, okay? So this is your yield. Now watch carefully what happens when I will change the yield. Okay, you see? No, you didn't? So watch. So this is 4.5. Now watch. Let's say I'm changing it to 4. Right? So this is the yield of the bond. This is a discount rate, right? And this is going to be calculated by, how it is going to be calculated?
Magic formula.
Exactly. It will going to be calculated using the magic formula. Absolutely correct, right? So when you actually change it here, you get the price. Now you can actually do it the other way around, right? And you can say,
Change the price.
right, so let's say you change the price to 120 and watch what will happen with the yield, right? So the yield is 1.89 and you can see that towards the normal, the yield that you have here, right, which is the yield on the market, the difference now is 251 basis points, okay? And you can see so this is percentages, this is price, right? And this is basis points, so it's extremely confusing, right? But you have to control, right? So if you want to understand, you open an account and you just go through screen by screen by screen, okay? Now, let's look on the yield curve. So if I do yield curve, it should give me the, yeah. Here. Yeah. So this is the US Treasury curve, you see? So this, okay, this is the rate of a month, 1 month, right? Everything is annualized until you go to, so 2 year was here. We said the 2 year is almost 4%, right? 397. It's very, very, very high, very high, okay? And this, what they do here, they interpolate. So you see that this is exactly what I talked about in class, right? I said that not all of them are actually being traded. So for example, the 2 year, the 3 year is being traded, right? And the 5 year is traded, but you see what they do here, they interpolate. So they calculate, they imply the 4 year here, okay? You see how it's done? And here, exactly from 7 to 10, right? You have the straight line because this point is traded, this point is traded, okay? But nothing in the middle is kind of traded, right? Or they don't rely on this trade, so they actually do this. So if you think about, you know, key rate durations, okay? You have the 7 year and the 10 year key rate duration, right? And then you calculate all the key rate durations of the bond in the middle, like I pointed out in class, by decomposing them into zero coupon bonds, right? And doing the interpolations that I did in class. And you can see it here as well, from 10 to 15, right? So the next one, if you have the 10, which is a benchmark, the next one which is being traded is a 20, right? And then the 30. So those guys, right, here, are actually being calculated or interpolated. That's why you see the straight lines. Is this clear? Okay, questions? And you can see here the values, right? You can see that the 5 year is 4093, the 10 year is 4415, the 20 year is 4965, right? So they give you the curve, they say the curve ID is I-25. So if you do I-25, okay, you will see the curve. Okay. This is for the US. Now, let's say you want the UK, right? You can actually click here, change it to UK, right? So you want the UK. So you can say United Kingdom, yield curve. Okay, and then it tells you like
Unite,
this.
unite.
Yeah, for example, right? So this is the United Kingdom, right? This is guilds. Guilds are the United Kingdom ones. Okay? Is this clear? Okay, so what we are going to talk about, so next time we will start talking about swaps. What we're going to talk about today, we're going to talk about the corporate curves. So these are the government bonds, right? What we want to do, we want to investigate corporate curves. So for example, if we look on IBM Corp, you can look on all the debt which was issued by IBM, right? This is a debt that was issued by IBM. You could, for example, look on Tesla Corp, right? This was oops. There is no debt for Tesla. Good job. Meta Corp. Yeah. So this is Meta. I don't know what Meta Platforms is, but you see, this is the debt which was issued by Meta, right? By Facebook. But yeah, let's go back to IBM. Let's go back to Bombardier because it's much interesting. So Bombardier Corp. So Bombardier actually does it's a Canadian company that kind of does the engines. No?
AI agent. Engines.
Engines. Airplane engines.
Looking for Bombardier?
Bombardier
Yes.
is a manufacturer.
Yes, it's manufacturing. Yeah, Bombardier, yeah. It's Bombardier Corp. Okay, this one. Yeah, so this is a debt which is issued by Bombardier, okay? This is a company, this is a ticker of the company, right? This is a coupon. You see that the coupon is pretty high, okay? The coupon is high because the risk of this company to default is also pretty high. So if you look on IBM Corp, you will see that the coupon is going to be much lower. You see that the coupon here, right? If you look on the coupons, right, it's much lower because you can see this 3.625, right? So it's a much lower coupon than what we had in Bombardier. Why is it like that, right? Because the company itself is considered to be less risky for default than the other company, right? So when you have the government bond, on top of the government bond, you have to, if you are a company that was to issue debt, you need to pay some premium because the bonds must be cheaper, otherwise nobody is going to buy your debt, right? So your coupon is actually higher. That's how you can attract investors, right? So here, if we go here, for example,
Because it's more risky than the
exactly.
treasury.
Exactly. So we go to here, okay, and you can see the description of the security. So once again, you have the familiar QSIP, you have the Bloomberg ID, and you have the ISIN. And then here you have a new thing which is called ratings. Okay, the ratings are basically reflect, right, how good the company performed, how bad or good it performed. Okay, and usually those companies, the yield will be higher than the treasury yield because you want to actually have some premium. The coupon will be higher. So if I look here, right, this guy is going to actually mature in 45. 45 is around 20 years, right? So if you look on the treasury of 20 years, it was around almost 5%. Here, right, the yield is actually higher. The coupon is 7. Okay. So you can see that, you can see the coupon here. Now you can do YAS, which is going to be your risk analysis. yield and spread analysis, okay? And here, there is going to be a spread, okay, to the government bond. So you see that the yield is 624, and I think the spread is here is G spread, I think, is 129. Now, if you want to find what is G spread, right, you can actually see that it's actually going to be the comparison to the treasury curve, right? So you can see that you have two, so the benchmark is actually coming from two guys. The one that matures in 46, which is kind of 20 years from now, and one which matures in 36, which is 10 years from now, right? But this guy matures in 45, that's why I interpolate. Is this clear? That's why I interpolate, right? And then when you look on this G spread, you take your yield here, 6341, and you subtract your spread in basis points, you get a 10-year treasury curve. Is this clear? Is this clear? Right? Any questions, David? You always have good, witty remarks. So. Any questions? David, any questions? Okay, David is dreaming. It's okay. All right, now, once again, right, you see that this guy is being traded based on yield, right? So once again, two people come together, they actually look on the yield, they agree on a price, and they agree on a yield, and then they use the magic formula to calculate the price. Okay? So the yield for this bond is said would be 624, right? And 624 is going to give me 108. So if I'm going to change it, let's say, to 100 at par, it is going to be equal to the coupon, probably, whatever the coupon is, right? 7%, right? And you can see that everything is changing. So now the spread is not 129, but 205, okay? Questions? Now, if you go back to Bombardier,
But how they align the coupon? Like,
Uh-huh.
what factor they consider when they try to agree on the coupon?
what they do, right? They ask the banks. They ask the investment banks what the coupon should be. Just like when the government is trading the yield, right? There is an auction. So they go to 19 brokers, okay, and they ask them, okay, what should be the yield? And then they say yield equals coupon, and then the principal equals to whatever debt they want to issue now, right? Using the magic formula. So they have 19 guys, and there is an auction. And you know, there is an elaborate auction there, and they're using the auction as they agree on the yield. That's how it works. Okay? These guys is the same story, right? You have an auction. You have an auction on the yield, so the company wants, okay, what should be the coupon, right? And they bid on the coupon. And there is the elaborate process of how they actually determine the coupon using some sort of a Dutch auction. Okay? So if we go to Bombardier, so let me show you something interesting. So if we go to Bombardier, right, the rating of Bombardier is actually lower than the rating of IBM. So if I click on this guy, okay, and I go to security description. Okay. Well. Okay. These guys are going to be, when they actually trade, they trade based on a price, not on the yield. Anybody has any idea why when the bankruptcy probability is high, why do you think they trade based on a price and not on a yield? Because people, well, in this case, they actually do agree on the yield. You see that it's actually very tight. But usually, people don't agree on, you know, if you have a low-rated company, it's very tough to agree on a price, right? on a yield, because you can have a bankruptcy there. So you think you're buying, let's say, a bond which matures in 8 years, but if it's bankrupt, it can mature in 3 years. And then you're basically screwed, right, for 5 years of further interest rate. So that's why then the yield is becoming a modeling question. You can't use the magic formula anymore, because people cannot agree on maturity, right? So that's why for lower rated bonds, they're being traded on a price and not on a yield, okay? And here for this company, you have the credit research, so you can look on the credit research and see, what people are actually thinking about this company. Now, the crucial 720, okay. The crucial, okay, so we are going to talk about this corporate when we go back to class. We are going to talk about the corporate market today. But before we go back to the class, I want to show you something. So XT, LTP. Okay. These are, this basically is going to be, in some sense, the most important thing that you can have from Bloomberg, right? Anybody here in the SMF?
I am.
You are?
Yeah.
Are you using this?
Uh,
You must use it.
Rarely.
Rarely, right? So,
I try to use this in this terminal, but I cannot.
no, but here's how you do it.
I mean the Excel, Bloomberg Excel here is not working.
It's not working?
Yeah.
Yeah, they block all the macros.
Yeah, but you can open this, right?
Run map.
You can open this shit. Let me show you.
XLTP, right?
Yeah,
Excel
XLTP,
template.
yes. Okay. They don't have Office?
You just haven't used this computer before, so it doesn't know you.
Oh, really? It's a piece of shit. I'm going to hack this system now.
No, they use a bunch of VBA to do all these macros in there, and the
I know.
UConn won't let it run.
I know,
Oh,
but I will let you show. I think I know how to hack it.
Oh,
Let's
Oh,
see, we'll
really?
see how to hack it.
please.
I don't know if it will work, but we can try, right?
Yes. Yes. I tried multiple times, but it's not worked.
So file, options, and where is this customizer icon? And I want developer. And I want developer, so macros should appear now. You see macros do appear, right? So let's see if I can hack it. You want to actually tell the people here that you want to actually, this is your right to use this thing. So they need to enable it.
You already download the Excel file?
Yes, I did.
But it doesn't have data.
No, you can do something, right?
Yes, I can. Being crushed. File. Options. Where the fuck are the options? Where are the options? Where did they go? Where are the options? Where did they go? No, I don't want to vote, but why doesn't the option work?
Can you try to click the Excel icon on the top of the left?
Where?
Top of the. Can you try? No.
It's not giving me access.
No, it doesn't, for some reason, unlicensed product.
They already run the developer sheet, no, tab, oh.
No, this is exactly what you need. This is exactly what you need. This is exactly what you need. But you see, it does populate something here. But why is it not?
Is it restart required? No.
File, then options. So, but where's the options here? They disappeared
Rerun it again.
because there was there.
I think it's here, but it's not just not able to use it.
Oh, I'm not able to do to read it. I see. They graded out.
Yeah, it looks like,
I see. Okay, so you need to insist. You need to insist that this should work.
You can ignore that.
This cannot, because in stores it works in stores. It should work here as well. Yeah, it should work. It works in stores, so it should work here as well. So if I do options, let's see, do I have a, and I go to add-ins.
not option.
Option.
No, that, forget that, that's for some reason it's a Bloomberg thing.
Yeah, but I can go to add-ins.
Yeah.
Right,
Here,
so
this is-
it's Excel and so. Oh, I don't have.
We already.
They did a good job of blocking it. So I can't, unfortunately, I can't. I thought that maybe I can
It's
actually,
not,
so you see the developers, that's how you enable smart,
Yeah,
right?
it's not active.
This. So it's like this, you go to file, you go to options, right? And then you go to add, to customize ribbon, and here you enable the developer, right? Enable the developer, and then you can have macros. But the trust center, maybe trust center settings. Okay. And let's say we have add-ins. Why they don't allow bloomberg? Because this is like this is an indispensable tool. Okay, so you can see here, right?
Yeah.
That you have the most important is XLT DCF, discount cash flows, because that's how you do the SMF, right? You open this and then you start changing the assumptions, right? Let's see, maybe it will launch.
Is it XDCF?
Yes. Yeah, it's XDCF, right? You can actually tell them that you want to actually, oh, wow, yeah, you did something here, you see? Yes. You can actually start changing, well, you can actually do that. I think here, you can change it to 56. And summary analysis probably something like that. Yeah, you should be able to do that.
enable the contain if you run the
What?
macro. Enable contain if you run macro.
Yeah.
How did you load the data?
What do you mean how I loaded the data? The data loaded itself, my friend,
So it doesn't,
Okay.
right? So you have 56,000 here, let's say 57. Maybe it works, I don't know. It's December, you want to make it, yeah, you see changes, watch. It changes here. So now when you do summary analysis, where's the summary analysis?
So because of you click enable developer, so now it's allowed you to download.
It allows me to download, but it doesn't allow, but you see the data, right? Yeah, it seems to me that it does, so here, right, this is going to be the projected ones, right? So if you, let's say, what company we have, let's say some US. Yeah, it changed. It didn't load, but it changed, right?
Yeah.
It didn't load, it should load, you're right. So when you actually change it here, right, it has to actually load all the data. So you want to actually talk to the people here who are responsible for Bloomberg and ask them why they blocked it. Because this is not good. As a finance students or FRN students, you want to have you want
Who's
to have
actually in
the-
charge of finance down here?
Who?
Yeah.
No freaking Catherine Penzak? Catherine?
Who do I gotta write the email to?
You
I'll
write
copy
it
you
to-
in it too.
You write it to Megan Hanaharan. You know Megan
No.
Hanaharan? She's the director of the program.
Sorry, my phone.
You write it to either Megan Hanaharan or to Michael
Michelle?
Yeah, Michelle.
Okay, I'll do Michelle. I know
Is
Michelle.
it Michael or Michelle?
Michelle. I call him Michelle. You know, our secretary, well, our administrative
Because
assistant calls
these
him
two
Michael.
terminals, these things should have Python and R on them. They don't have Python or R on them
No,
either.
fuck Python and R. First you
Yeah.
take care of that, and then you can actually
So
worry
you don't
about
have a
Python
data
and R.
now?
No, you do?
No, I don't, but you had before, that's why I asked.
No, because I actually, you see what I did? When I get here, right, look, you can actually do it in the following way. You do XOM, XOTP. Sorry, you do XOM, US, right? And now you do XOTP. Okay, and it's XDCF, right, you said. So XOTP, XDCF,
Oh, okay, so you loaded something.
so then I do open, right? So you want probably to close this shit. Close it here. And you want to open it. Yeah.
Because ideally, we should be able to save these spreadsheets, and it won't let us do that.
Exactly.
It won't let us do it
I
with
know,
the data.
but it won't let you to do many things. But you can see what it does, right?
Yeah.
When you have the company, it will actually load it, I think.
Ribbon, customized ribbon. Forgot that, that's not part of the,
It goes to customize ribbon
yeah, and
and
then
developer.
He undo and then.
No, I
Later,
have
can
the
you
developer
explain
now.
how they usually do
I mean-
when they
Remove?
enter the
Yeah,
Bloomberg
then-
trading challenge, like
Why does
But
it?
it's-
trade on
how is
Bloomberg
it- I
and
mean,
No, but the Bloomberg trading challenge is
Can you
already
open it?
gone, it's
It's
irrelevant.
next
Next
August.
semester.
Supposed to do it in the
Next
fall.
semester, so next semester you come to me and we'll do it together.
Okay.
Sure.
They will,
Thank you.
yeah. I used to actually run until they suspended me in 23.
You run what, the Bloomberg challenge?
Yeah, I actually won the Bloomberg competition, not me, but my students won the Bloomberg competition in 2021.
That's what you asked
And
about?
2024.
No, 2024 they didn't
We're
win.
looking at
They
oil
were like
commodities,
maybe
um,
16th or 17th, but they didn't win.
68.
68, yeah,
yeah.
but they didn't win.
Yeah.
But in 2021 they won.
What? Like
Yes.
national or globally?
Okay, let's see.
Wow.
Wow.
I don't even remember. I searched this, but I don't remember.
Because you don't, right, so here,
I have shared on 2024 and 2025.
Bloomberg
Chat.
trading competition. Yukon. No. Here. 2021. You see, on top to win Bloomberg first global trading challenge. We were the first one to win it. You see?
Last year, the first team they gained 4 million.
I know,
Yeah.
but they were very good.
Yeah,
They
1
were
million
very good.
return within 25 days.
Yeah, they were very good. Yeah, yeah. But I don't know. I mean, what was the team?
Hong Kong.
Hong Kong. So probably they did something right. I don't know how they did it, but they did something right. Maybe they did use the AI or something.
Maybe they have like internal information.
Internal, yeah, they may actually have insider information. Yeah. Okay, so any questions on what we covered today, on what we covered with Bloomberg? Okay, so we go now and we will do now continuing class. Okay, so I need to get out of here.
Could you tell